Yeah,
or
that's
Harker?
correct. I mean, I think that the Fed is having a very difficult exercise ahead of itself. It has to communicate its ongoing intent to maintain a very tight monetary policy stance, but it wants to distinguish the pace at which it's tightening from the level of rates, and that's a very delicate calibrating exercise. If you bring us back to the minutes, the FOMC minutes, you saw in the minutes that there was a lot of conversation around this idea of risk balancing, mitigating the risk of overshooting on the rates front versus the risk of underdoing it in terms of bringing down inflation. I think the balance of risk is gradually balancing itself out, and the Fed is increasingly intent on considering tapering the pace of rate hikes as it goes into 2023 in an environment where this global policy tightening cycle has brought about a significant slowdown in global activity.
Okay, so this construct then that we're dealing with right now is one where the markets and the economy have to try to find some kind of a balance point here. Steve, I mean, this is a situation right now where if you look at the Fed and what it has to do, it's fairly evident. The clear and present danger in their mind is inflation. So is there any other option right now than to do it until they see some signs that inflation is actually cooling off?
I don't think so. And before I answer your question more fully, Dominic, let me just point out that Harker yesterday said he expected to end the year well above 4%. So he's a very kind of middle-of-the-road guy. He's not even an economist, but he's been a member of the FOMC for a while, and you want to follow him as where maybe the middle is on all of this stuff. As to your question, it's also well worth remembering the Federal Reserve believes that it just became restrictive with rates. So think about that, Dom. You and I and the markets have endured this huge increase in rates to this point. The Fed feels like it is only now at this point restraining the economy. What does that mean? It means up until the point that the Fed got restrictive, it was either neutral on the economy or it was even stimulating the economy. So in terms of the Fed stopping now and whether or not we would see any influence, Daly pointed out maybe we're seeing some slowing in the economy right now, but it's probably well worth not looking so closely at the financial markets and more looking at the real economy, Dom. And from that standpoint, the Fed sees some cooling on the headline side, but is really concerned about continued pressure, which we've had month after month in the services side, both driven from perhaps some wage and labor inflation as well as other input costs.
Greg, we're going to give the last word to you here. In your expert opinion, where is it that we are likely to see the first signs that we are at or just near a peak in inflation?
Well, we've already started seeing it in terms of headline inflation with the recent fallback in energy prices. What we really want to be looking at is core inflation, and when that starts to turn, I wouldn't be surprised that we start to see that turning towards the back end of the year with what's happening on the housing market front. Let's not forget also that the Fed has communicated clearly with its dot plot that it has another 125 basis points of rate hikes locked in for this year. So that would bring us from the initial onset of restrictive policy towards much tighter policy. So I think we have to calibrate our expectations, as the Fed minutes said, in terms of what the Fed will eventually do. It does not want to sound excessively dovish, but it is increasingly considering that the sum of the tightening from different central banks around the world is greater than the individual tightening processes, and the interactions and financial market conditions implications will have an effect on how the Fed decides to move forward going into 2023.